You finance every single thing that you buy. You either give up the interest that you could have earned or you pay the interest to somebody else. See, some people will challenge me on this. They think that, oh, well, if I use 0% money, I am not giving up this interest. So we're going to dig into that today on today's episode. Welcome back, Money Multipliers. Welcome to the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? So for y'all who joined me in Nashville, how freaking fun was that? I had a blast. Honestly, I felt a little rusty because we took off 2023. We didn't do any live events. We did some at the beginning of the year, our own hosted events. But 2024, I wanted to do another annual live Money Multiplier Mastermind, and y'all showed out. I mean, that was a lot of fun. The live bands, being right there in the downtown Nashville area in the heart of Music City. I mean, I went on a lot of walks. I visited a lot of cool parks. I ate a lot of good food as well, too. I mean, they got a lot of good restaurants right around the corner there from the hotel. There's this place called the Euro, Hannah, you know how to say Euro. There's this place called the Euro House, and it was just right around the corner. I would say one of my top best Euros I've had, and they have like the little Delmates, the stuffed grape leaves. I mean, those are like my favorite food in the whole entire world. So that was a lot of fun. I mean, you saw Jonah and Jeremiah. They did some great presentations. We had a live game show. You know, Craig Yenny, Chris Noggle, Mike Samet was there. We had Anthony Rushings and Jason Cahill from the First Lean HELOC guys. So a lot of great information. And y'all stay posted. There will be a way that you can obtain that recording of the 2-day mastermind. I'll be posting out some stuff on my social media, so follow my main channels, Hannah Kessler, Hannah spelled the same ways forwards and backwards, Kessler with one S, or tune into the Money Multiplier channels on Instagram, Facebook, and different platforms. So I'll definitely be showing you how you can go and obtain the recordings. I mean, Miss North Carolina showed up. Her and I really got to know each other when I was up in New York City. I did an interview with Rudy Giuliani. I'll be posting those videos here soon too, okay? So stay posted. But we were sitting right next to each other in the New York Bar Association, and we just got to chit-chatting, and I had no idea who she was. I just thought she was a beautiful young woman, and we really started to vibe and chit-chat together. And she showed up, her and her boyfriend. That was a lot of fun. We had the live band at the VIP pre-party, so it was definitely the Nashville experience, and hopefully y'all even caught that like in the foods. If you notice the Southern barbecue and then the Nashville chicken, of course. So it was a lot of fun. So we will be doing another one next year, October 2025. I will be hosting another live mastermind. I'm coming out to you, my West Coast people. Little asterisk there, because sometimes my team will persuade me another way. But I know we did like the East, like Central East Coast. So we'll come out there to the West Coast here soon. So with that being said, actually at the time of this recording, I got to leave my house here in a little bit. I'm going to go over to Orlando. There's a live event that I'll be teaching at called The Money Show. And people have been asking me, well, Hannah, what is this event all about? Well, anything money related. It's The Money Show. So, you know, there's going to be folks there talking about crypto. Maybe it's real estate investing. Some restaurant owners will be there. So anything money related, they got some big name speakers. So shout out Money Show, go and check them out. We've been doing a lot of their live events and virtual webinars. So great place just to further your knowledge and your education when it comes to the money topic. But with that being said, I don't know if I have any more other thoughts just besides the content I want to talk about here in today's episode. So let's get into it. Now, for my folks who are listening right now, maybe on your podcasting platform, You may want to tune into the YouTube version for this episode. There are some things that I'm just going to be posting up there of how I think it's best to frame the conversation around how we conduct our banking business in our life. You know, Nelson Nash, what does he always say? You finance every single thing that you buy. And let's kind of think about it. Well, how do I buy things? Well, I pay cash for things. I can bank finance it. I can lease it, rent it, or I steal it. Those are my 4 options. Hopefully nobody's stealing things. When we lease an item, right, it's just us renting it, all right? We don't build up any ownership or equity in that item, and at the end of that term or that time, then we got to return that item. Like, right, car leasing, right? People like to lease cars because they can drive a nicer, newer car and not have to have a high monthly payment for it. But then obviously at the end of it, you either maybe buy the car or you give the car back. I used to do this a lot actually with my cell phones. I used to lease my cell phones and then buy it from Sprint. Sprint's no longer around. It's now T-Mobile, which I haven't fully grasped yet. But I don't know. Just there's something nostalgic about Sprint. But I used to even do it with my cell phones. You know, so we can lease an item or we can bank finance it. Okay, I can go down to the bank or ask to borrow the money, and then I'm paying them the interest. Or I can save up and then go pay cash for that item. And, you know, saving is great, right? I like when people are buying things with cash because it makes me understand that they have a good discipline and habit when it comes to their money. But when we go and pay cash for things, we're losing out on the future earning rights that money is buying us, or AKA what's called the opportunity cost of our money. So if I have money, let's just say it's down in my Wells Fargo account, it's earning me a 1% interest in that checking account. And let's say I want to go and buy a $2,000 iPhone. Speaking of, I haven't even looked into that. You know, the new iPhone 16s are out. How much are they nowadays? I have no idea. I didn't even look into it. So let's just say this phone's going to cost us $2,000. So that might be a little high. I don't know, but don't come after me. So let's say I want to go buy this $2,000 iPhone or bicycle. And I have that $2,000 that's sitting in my checking account earning me 1%. Well, if I just withdraw that $2,000 out and I go pay it to Apple or the bike shop, they now have my money, which is fabulous. They get the money, I get the iPhone or the bicycle, and then everybody walks away. But now that $2,000 left my checking account and I'm no longer earning that 1% that I'm getting down at the local bank in my checking account. So in order for me to go out there, get that $2,000 back inside of my pocket, earning me that 1% interest again, I got to go out there and I got to work for it or earn it somehow. And it all goes back to the quote from Albert Einstein. Compound interest is the 8th wonder of the world. Those who understand it will earn it, and those who don't will pay it. So all we're doing with these whole life policies that's designed for high cash value banking, I'm just using it to earn my uninterrupted compounding, and then I'll leverage from the policy to then go buy that $2,000 iPhone. Now, that $2,000 never left my policy because I took out a policy loan. I'm not withdrawing the money, and I was able to go and obtain the iPhone. So now, once I borrowed from my policy, I'm just going to start putting the money or paying myself back into that policy, acting as my honest banker with myself. And I'm kind of saying these words, but I'm also thinking in my mind right now, you know, when you go out there and you just pay cash for things, You go and right, so let's just make believe like it's like $2,000. You have $2,000 right here. You withdraw the 2,000, so now you're back at zero. And so now what you got to do, because that bicycle and that iPhone is going to wear out on you, you got to start saving up again to hit the 2,000 mark again, because now you're going to go pay cash for in the future when that iPhone wears out on you and that charger doesn't last as long as what it used to do, right? We've all experienced that with cell phones. So it's almost like you're starting at this $2,000 point and then you hit zero. Then you climb back up, you hit the 2,000 point, then you're back at zero again, right? So that's paying cash for things. How can I incorporate an uninterrupted tailwind so that I don't keep hitting that $0 mark? Or what I like to call it as, how can I do this without taking one step forward, two steps back? That's what I think of as paying cash for things. And how we're doing that, my money multiplier listeners, all we're doing is we're just putting money inside of the whole life policy, because now I'm going to get that uninterrupted compounding on it. So I'm not going to get into loans versus withdrawals today, and maybe that's a topic I probably need to record here soon. I know a lot of y'all asked about it at the mastermind, and I hopefully did a good job of hitting those pinpoints in our live Ask Me Anything session and, questions I was just asking the speakers after they got done. But I won't get into that right now. But one thing I will say before we get into this is that you need to start thinking like a banker. Loans are assets to banks, and we can't think about the policy loan to ourselves as it's a debt, it's an expense. Yes, it's a payment, but I love paying my policy loans back because, number one, I'm playing honest banker. Don't steal from your banking business. Don't steal the peas. But then number two, if I really do this and I pay myself with interest, money will flow and grow to where it's respected. You will see those numbers start to skyrocket if you just treat your money just how you treat the banker's money. So that's all for my PSA there. Anyways, you finance every single thing that you buy, Mr. R. Nelson Nash. Unless you understand the problem, the solution won't matter to you. This is the thing. Nelson Nash talks about this in his black book, Becoming Your Own Banker. And let me just preface this as well. If you have not read Nelson Nash's book, Becoming Your Own Banker, or you have not watched our 90-minute presentation, I would pause the video right here. If you are listening on podcast, click the description. You can see where you can find the full 90-minute presentation. Or if you're watching on YouTube, click the show notes below and you can also find that recorded presentation. So definitely start there. And if it's been a long time and you've been following us since you've seen that, it might be good just to go back and hit the basics. Right before the mastermind, I actually went through and reread Becoming Your Own Banker. And every time I go in there, I take another like colored pen or highlighter and I'll start to line out different things that pop out at me that maybe it didn't pop out the time before, because you're in different places as you go through life, different headspaces, and so some things could kind of stand out a little bit more than what it did before. But in that black book, Nelson talks about how if you can simply control the banking function in your life, you have just beat 95% of the population, because what you do in the financial world is compared to what everybody else is doing. So if I can take back that control and not have to give up interest or pay interest to somebody else other than myself and my family, I have just beat 95% of the population. So that's the first thing that we got to understand, is that the problem is not our rates of returns in our investments, or yeah, it can be the economy, but it's about how you can control that money and you being in total ownership of that transaction that is happening. That is why we are using the policies, not to get higher rates of return or tax benefits. I mean, yeah, we get some tax benefits, but if you're just trying to evade taxes. No, you shouldn't be doing this. But there are some benefits why we're using the whole life policies. And the problem that we're solving is that I no longer have to rely on the government, others, or banking institutes any longer. So let's just make believe that we are in the market and we want to go purchase ourselves a car. All right. And when I purchase that car, in normal sense, I'm going to go down, yes, pay cash for it, bank finance it, or lease it. But in my examples here, I'm going to compare only two options. I'm going to compare bank financing it versus financing it within my banking system, my policy, because we need to start using the F word. The F word is finance. And finance is a good term when we are financing things within our privatized system, not somebody else's banking system. So I want to shout out the banking bros, the cash compound. Go and follow them on TikTok, Instagram, YouTube, Facebook. Jonah and Jeremiah, great dudes. They live out in Greenville, South Carolina. But all these presentation slides come directly from the Do brothers. So when I go down here and I am purchasing a car, traditionally what folks are doing is they're going and into the bank and say, hey, Mr. Banker, I need a loan for a car. The banker will go in there and say, okay, how much are you looking for? What are you buying? Let's make believe that it's a $55,000 car that we're looking to buy. And, based on the rates, your credit history, and basically all of the prostate exam that you got to go through and all the paperwork you got to fill out at the bank, they either approve you or deny you that loan. Because remember, they can deny you. It's not your money. It's the banker's money. So let's just compare if I were to do this the conventional way. My vehicle price is $55,000, and let's say the rates are 7.2%. And I am going to have that loan outstanding for 72 months, 6 years, 72 months. Well, if I take that loan from the banker, the total cost would be $55,000 for the principal, and my interest payments is $13,737. That is what I would pay as extra to the bank to use their money. And that's pretty straightforward. I like to start here with cars because we all get cars. We've all bought in cars, driven cars, ridden in cars. We all understand cars. So if I were to go down and get that loan, $55,000 over the 72 months, total interest I would pay is $13,000 and some change. Well, let's say if I finance this through my privatized bank, aka taking out a policy loan. First of all, let me say this. When you want to take out money inside of your policy, what do? I pick up the phone, option A, or I can log into my online portal and say, hey, I want a loan. Well, let's say I call them this time. Ring, 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 ring. That's the ringing, okay, apparently. So you call up to the insurance company. And let's say Susie at One America answers the phone. And Susie says, hello, can I get your name and your policy number? I give it over to her. Here you go, Miss Susie. She says, okay, Hannah, how can I help you today? I tell Miss Susie, I would like to take out a policy loan of $55,000, please. She says, okay, would you like that directly deposited to you, or would you like a paper check mailed to you? I would like that directly deposited, please. Okay, Hannah, you will receive that loan payment anywhere from 3 to 10 business days. Have a wonderful day. Boop. And then actually the insurance company, they always say, and we thank you for your business. So now I got my policy loan. I take out that $55,000. I walk into the car dealership and I purchase the car. I paid cash for the car. I took it out from my bank account and gave it and paid cash. Now, because I borrowed from myself, I'm going to pay myself back and charge myself interest. Let's charge ourselves the same amount of interest as if I were to go down to the conventional bank and ask them to allow me to take out a loan. So $55,000, I'm going to charge myself 7.2% interest. I'm going to pay myself back over the course of 72 months. Total cost for the car, $55 in principal, $13 and some change in interest. However, we did take out a loan from the insurance company. So when I take out a loan from the insurance company, what do I need to do? I need to at least pay my annual loan interest charged from the insurance company. Because yes, when I take out policy loans, I'm using the insurance company's money in the real world. So when I take out that loan, they're charging me interest. Right now, loan interest rates are anywhere from 5 to 6%. But I won't get into that today. Maybe that will be next week's episode. So when I take out this loan from the insurance company, they do charge me interest. So I'm going to factor in my equation here, the interest that the insurance company is charging me to use their money. Remember though, my $55,000 still sits in the policy and it's growing and compounding. Okay. So if I take into consideration the interest that's charged from the insurance company, I have to subtract $87.75. So total paid for the car is $59,962. So here's my question to y'all. Would you rather keep $59,962? Would you rather keep close to $60,000, or would you rather pay almost $14,000? Would you pay $14,000 or do you want to keep $60,000? Do you see what I mean when I say it doesn't matter how much you make, it only matters how much you keep? You can do both of these options. All I'm saying is that you are going to go buy the car anyways. Why not just finance it through your banking system instead of letting the bankers get all of that money on you? Let's go to another one. Let's do some equipment. You know, my father, he was a chiropractor. He had to go buy adjustment tables and all of the machinery in his office, the x-ray tables and all that stuff. So let's say you're a business owner and you need some equipment or new computers or lighting or cameras. Well, let's say this equipment is going to cost us $40,000. Let's say that I'm going to go and finance this through the conventional way. $40,000. Let's say they're going to give me a loan for 6.25%, and we're going to have this loan outstanding for 5 years or 60 months. If I were to take this loan from U.S. Bank, the total cost of it would be $40,000 as the principal, and we just paid $6,678 in interest. Straightforward, right? Let's say I finance this through my privatized bank. I take out my $40,000 from my life insurance policy, my whole life insurance policy, and I'll put a quick little asterisk in here that if somebody is trying to talk to you about the infinite banking concept and they're trying to use an IUL index universal life policy to do it, it is not the vehicle to be used to conduct your banking business in your life. Can you? Absolutely. Would I recommend it? No. Go read, I want to say it's on page 28 of Nelson Nash's book, Becoming Your Own Banker. All right, so I'm taking out $40,000 from my whole life policy to go buy this equipment. I'm going to charge myself the rates that the banker would charge me, which is 6.25%. Have it outstanding for the same time frame of 60 months. So my total cost for the equipment, $40,000 in the principal, and I charged myself $6,678 in interest. But I took a loan from the insurance company. So what do I make sure I do at least at the end of each year is pay my annual loan interest. Hannah, how do I know how much loan interest that I need to pay to the insurance company? Good question. When you're a Money Multiplier member, your implementation specialist will know this for you and can get you this information, but also you receive a letter in the mail from the insurance company at the end of the year. So if I factor in that interest that I'm charged from the insurance company, I subtract $52.90. So my total dollars that I kept left here was $41,000 and some change. Would you rather keep $41,000 or would you rather pay $6,700? You get what I'm saying here? You finance every single thing that you buy, and this is why you want to control the banking function in your life. Let's say we go to school now. And y'all, college tuition, I mean, it is pricey. Some of y'all that I'm talking to, your guys' student loans, holy hell. So anyways, but what can I say? I dropped out of college and my grandpa was not very happy with me. So, this is just kind of a chart here of the average cost of college between the 2022-2023 time. I mean, for a 4-year out-of-state college, total cost just for 1 year is $45,000. I mean, college is just not cheap. And I'm not bashing college. Sometimes people, they say, they have their thoughts and opinions around college. I think people are now starting to wake up about when college is necessary and when it's not. But, I think college is a great thing for some students and some people. Maybe it's their academic that they're getting into. Maybe it's the social, experience that they are wanting to live, which I get, right? So I was literally a high schooler going to college parties. That was not good. Listen to my Person Behind the Pod podcast. So you can hear all about my rambunctiousness I got myself into. But let's say I'm going to go to college, or maybe you have a student that's in college right now, or maybe you have a child that's growing up and you're thinking about college. Let me say this. Don't put your money into a 529 plan. I will tell you or share with you my 529 horror stories. Reach out to me. But if I were to go the traditional way, take out these student loans, let's say it's going to cost me $120,000 for the 4 years. And if I were to go down to the conventional bank, ask to borrow the $120,000, let's say they're going to charge me 6.53%. Let's just call it 6.5%. Reminder, when you go down to the bank, you have to show all the documents, the paperwork. You got to get approved for that loan and show the banker that you're worth it and that you will be paying this money back. So the time period, 360 months. When I take out that loan and I use it for my college education, I'm now got to pay back the $120, but also my interest that's charged, which is $153,000. Just in interest alone on this $120,000 in principal. Do you know how long 360 months is? That is 30 years. I mean, some of y'all are taking out student loans for 10, 20, 30, 40 years into the future. And if you have that loan outstanding, you are paying close to $154,000 in interest alone, and your principal is only $120,000. I mean, really study up on what amortized interest in those scheduled payments really are. You'll be surprised when you look at your mortgage payments, for instance. But let's say now, if I compare it to me financing it through my policy, I take out the $120 from my whole life policy. I'm charged the 6.5%. I'm going to have it outstanding for 360 months or 30 years. So the total cost of that, the $120 in principal, I paid myself the $154,000 in interest. But we got to take into consideration the interest that the insurance company charges us. So I subtract the $112,000 for a total that I kept of $162,000. Do you want to keep $162,000 or do you want to pay $154,000? The choice is yours. Let's do a house. All right, let's say that I'm going to go in here and I want to purchase a new house for myself. Well, if I go out here and I'm looking at the markets right now, I find a cute little place in, Golden, Colorado. That's where I kind of want to find a cute little place. Actually, you know what my thing that I've been really looking into here recently? Apartments in New York City. They are nuts. I was Actually, I was up in Nashville and I brought my best girlfriend Sadie with me. Shout out Sadie. Some of y'all know her. She's on the application team. But Sadie and I were just laying in bed one night. We're on Zillow and we just kept sending properties back and forth to each other of like $45 million, $50 million listed properties in downtown New York City. I mean, dang, it's nuts. So that's what I've been kind of telling myself is that, Hannah, when you become a billionaire, you can then have your penthouse in New York City downtown. All right, so let's say that I'm going to go purchase myself a house and it's going to cost us $400,000. The current rates going for that mortgage is 6.3%. Let's call it 6.5% again for easy numbers. So if I take out that $400,000 loan, 6.5% for 30 years, total cost of it that I'm going to pay in interest is close to $400,000. And y'all, to kind of circle back to my one comment that I made, go and look at your mortgage payments right now, because most of us are probably paying mortgage. Go and look at when you get your statement at the end of the month, look at the payment section and then look at the interest that you're being charged, because some of y'all have very low interest rates, I bet, because you lock them in at the low rates. And that's why people are not moving right now. And that's why my Pelican Bay house is sitting right now in Daytona Beach, Florida. So I'm actually going to have to rent it out soon. Anyways, so look on your mortgage payment and on there, it will mortgage statement, and on there you will see the cost that's going to your loan. Okay, so your monthly payment will be on there, and then it will tell you the interest that it's going and paying off. And you'll notice that on the payment, it is not like 3% of your payment. The interest that you're paying is a lot higher than just 3%, because in the early onset years of home mortgages, most of those payments are going towards the interest portion that's due. And a lot of y'all who follow me, you guys know this, but I just always say it because there's some people who could have just found me right now. So hello, welcome to the family. And we're not taught about money. And so these are things that you should really look into, think for yourself and question. And that's a resource I just wanted to provide to y'all. So if I go the conventional financing way, I'm going to have to pay $400,000 in interest. Well, if I go the private financing way, take it out of my whole life policy, the Bank of Hannah Kessler, I take out that $400,000. I'm going to pay myself back the 6.5% as if I were to go and take it from the bank. I'm going to pay back that loan over 30 years. Total cost, interest I paid to myself is again the $400,000, but let's keep in mind we got to pay interest to the insurance company to use that money. So I subtract $298,000. So I kept $501,000 to myself. Do you want to keep $500,000 or do you want to pay $400,000? So it got me kind of thinking here just now too. There's no prepayment penalties if you go into your policy and pay back your loans early. I get that question a lot. So no, loans are not required to get paid back. Why are they not required? Because a loan is just a prepayment of the death benefit. So any outstanding loans at the time of our passing will just get subtracted from the death benefit. And I can go and pay back loans at any time. I mean, it's just me replenishing that cash value bucket for myself. Nelson Nash kind of says this too. He says, the life insurance companies, they kind of failed when they named a whole life policy life insurance, because it's more so a monetary banking self system with the death benefit that's just tied into it, or what I like to call the cherry on top of the cake. But the insurance companies aren't gonna, that's not a very nice fancy word, right? If you have this big long name of monetary self-banking system with a death benefit on top, so they called it whole life insurance, right? So just things that they don't teach us about. How about private lending opportunities? Actually, shout out Chris Rude. I just funded one of his deals here actually 2 days ago. So just got into another private lending deal. And yes, I borrowed it from my policies. And let me say this too. And I think we're going to get into it in the slides. But when I borrow from my policies to go do investments, when I have that money out there in investments, yes, I have to pay tax on the gains that I'm making outside of the policy in my investment. And so that's why I actually have a business trust in place. And there's some ways that you can use the tax code to minimize some of these tax liabilities to us. So that's what I use, is I lend through my business trust, and that's how I'm minimizing some of these tax costs. But go talk to your tax professional, because I'm not a tax professional. I take advice and am still a student of my tax professional. But if you want some context, just reach out to me. So let's say that I'm going to use a policy loan for a real estate investment. Let's say a borrower calls me up and they need $100,000 of my money. They need to borrow $100,000. And they're going to pay me 15% interest on this deal. Well, and this is annual return, okay? And yes, I want it to cash flow monthly. Anytime that I'm looking at investments, I want you to cash flow monthly. So this is kind of just comparing if we take a home equity line of credit or the home equity rates versus if I'm going to go in there and use my policy. So if I do it the conventional way, take out $100,000, maybe it's from a line of credit, or I put up that second mortgage, or maybe I just go down and ask to borrow $100,000. Let me tell you, it's not the banker's favorite thing to know it's an investment property. But if I take out the $100,000 from the bank, they're going to charge me 9.7%. And we're going to have it outstanding for 12 months. Total cost, $100,000 in the principal, $9,700 is our interest that we got to pay to the bank. Let's say I take it from my policy, take out the 9.7% over 12 months. That means I paid myself $9,700. But keep in mind, I didn't really pay myself. It was my borrower who's paying that interest back to me. Let's talk about this from Nelson Nash's book and his grocery store example. In order to have a successful grocery store, don't you have to have multiple customers that come into your store and buy from you? I mean, you would not be a very successful business owner if you were your only customer. So it got me really thinking here, because I am getting deeper and deeper into investing now. Because given I'm just a 25-year-old girl trying to figure this all out, have just really good mentors who I just follow and try to learn from their mistakes. But I was thinking about this. I'm like, okay, this is what Nelson is talking about when in the banking system, comparing it to the grocery store example in business. I need to have multiple customers to make this successful. So yeah, it's me, Hannah Kessler, borrowing from her bank, but I also have other borrowers and entities that will come in and borrow from the bank of Hannah. You get what I'm saying? So instead of me paying the interest back to my bank, my borrower now is paying that interest back to my bank. So when they're paying me back that $9,700, that's what I keep, but we pay the loan interest to the insurance company. Let's call it $2,700. So now we kept $106,000. Let's call it 107, round it up a little bit. So do you want to keep 107,000 or do you want to pay 9,700? So if I add all of these different examples, the vehicle, the equipment, the education, the home, and the investment opportunity, let's see how different our stories are. If I go option A or option B, option A being the conventional financing route, the total cost over those 5 projects, it cost me $583,775. Where in my privatized banking system, I kept $871,664. Last time I'll ask y'all, do you want to keep $800,000 or do you want to pay $500,000? Again, the choice is yours. Now, I'm just going to direct you to some pages of Nelson Nash's book. So page 52 to 53 in the equipment financing example, it talks about how the extra money goes, or the interest that we pay does go to the insurance company's general portfolio. So go and study the equipment financing example if it's been a while since you have seen all of this. But Nelson does talk about that it takes an average person at least 20 to 25 years to build a banking system through life insurance to accommodate all of his own needs for his finance. This is not an overnight process. This is a marathon. It's not a sprint. It's not a get rich quick kind of deal. This requires discipline, it requires rethinking your thinking, and it requires you thinking long range. And those are a lot of the habits that we got to overcome in order for the infinite banking concept to really just even work in your life. And that's hard for some people. I get it. I mean, it's shifting your thinking and your habits of what you've been taught all these years. And go back to the backwards bicycle video on YouTube, right? Just type it in. It's from a channel called Smarter Every Day. I think that's why it was so easy for me as being second generation into this to grasp it a lot quicker than my father and mother did, because I was able to retrain my thinking at a younger age, and it's easier to do that when you're younger rather than when you're older. I mean, right? You've heard it all the time that children, it's a lot easier to teach them a new language at a young age versus when you're older, it's harder to learn that new language. And that's all we're talking about, baby. We're just talking about the money language here. So thank you y'all for joining me. I hope this was helpful. Again, shout out to the Banking Bros, the Cash Compound. They are phenomenal dudes. Go and research some of their content that they're pushing out there. They go live quite a bit on TikTok if you guys are TikTok users. I feel like I'm the only person in the Gen Z generation that doesn't use TikTok. So I will be back next week. I think maybe next week I will do the differences between the loans and withdrawals, and we'll just have a quick conversation about it. But keep following me around. We got some live events coming up. So actually here soon, Noggle and myself and Joseph, Mr. Helock, we're going to be down in Mason, Ohio at the Great Wolf Lodge at the annual Ohio RIA event. Come and hang out with us. All right. I mean, just text me, call me up. I will be more than happy to see you. Come and join us for some of the presentations. I'll get you in for that event. And keep tracking and just keep doing good, y'all. I mean, I'm very, very proud of you. I know we're getting into the later quarter 4 of this year. Oh, and Halloween's coming up. Oh my gosh, tell me what you guys are being for Halloween. I'm actually thinking about hosting a little get together at my house for all my girlfriends. But keep going, okay? This is not the end of it. I know we're about to get into the holiday seasons. Don't quit now. Keep going, because every minuscule little progress that you're making, it's going to keep pushing you in that direction that you want to go. I know some days you're going to make a lot of progress, some days not so much. You're going to have ups and downs, but I'm telling y'all, just keep pushing. You have the community here to keep supporting you. Reach out if you have any questions. So with that being said, thank you everybody for joining. I will be back next week. Take care and have a wonderful week. Talk to everybody soon.